What's up, everybody? It's James Nash, and welcome back to our Options Trading Masterclass Series. We're diving deeper into the exciting world of options. And today, in video 3.4, we'll be breaking down 4 fundamental option strategies that every trader should have in their arsenal. Whether you're just starting out or you're a seasoned investor, understanding these strategies can help you manage risk, generate income, and potentially amplify your returns. So, let's get started. Alright, first up, let's talk about covered calls. This strategy is all about generating income on stocks you already own. Let's say you're bullish on Apple long-term, but you think the stock might trade sideways in the short term. You can sell a covered call option which gives the buyer the right to buy your shares at a specific price, the strike price, by a certain date, the expiration date. In exchange for selling this right, you collect a premium. Now if Apple stays below the strike price, you get to keep the premium, and if it goes above, the buyer might exercise their option, and you'd sell your shares at the agreed-upon price. It's a great way to potentially generate some extra income on your holdings. Now let's flip the script and talk about cash-secured puts. This strategy is like getting paid to buy a stock you want to own at a discount. Let's say you've been eyeing Tesla, but you think it's a bit pricey right now. You can sell a cash-secured put option, which means you're obligated to buy shares at the strike price if the option is exercised. But here's the kicker. You get paid a premium upfront for selling that option. If Tesla stays above the strike price, you keep the premium. If it dips below, you buy the shares at a price you were comfortable with anyway. Chapter 3. Protective puts, shielding your portfolio from downside risk. Now let's talk risk management with protective puts. Think of this strategy as buying insurance for your stock portfolio. Let's say you own a bunch of Amazon stock and you're worried about a potential market downturn. You can buy a protective put option, which gives you the right to sell your shares at a specific price. If Amazon's price drops, the put option acts as a buffer, limiting your potential losses. Sure, buying the option costs a premium, but it's like paying for peace of mind, knowing your portfolio has some downside protection. Chapter 4. Long calls and long puts, leveraging your bets for potential big wins. Finally, let's dive into long calls and long puts. These strategies are all about leveraging your bets for potentially higher returns. Buying a long call option means you're bullish on a stock. You're betting that the price will go up, and you'll profit if it rises above the strike price plus the premium you paid. On the flip side, buying a long put option means you're bearish. You're betting the price will go down, and you profit if it drops below the strike price minus the premium. These strategies can be riskier, but they also offer the potential for bigger wins if your predictions are right. Outro your options trading journey starts now. That was a breakdown of 4 basic yet powerful options trading strategies. Remember, options trading involves risks, and it's crucial to do your research, understand the mechanics, and potentially consult with a financial advisor before making any investment decisions. This video is for educational purposes only, and I'm not a financial advisor. Stay tuned for the next video in our Options Trading Masterclass series, where we'll dive into more advanced strategies. Don't forget to like, subscribe, and hit the notification bell to stay updated. See you in the next one.